Good afternoon. So today we are here to talk about global macro outlook and approaches in managing portfolio for the next 12 months or 24 months. As we enter the final stretch of 2024 and just before the election, numerous potential catalysts are on the horizon. Three questions we're going to be addressing. Of course, there's going to be much more, but the most important questions is, how does Fed easing affects both public and private markets? So public is hedge funds, private markets are private equity and venture capital. What might new political configuration in DC mean for your portfolio? We don't know yet because elections is next week. And number three, what to expect from the third quarter reporting season. So please allow me to quickly introduce my panelists today. To my left is Peter Boockvar, Chief Investment Officer of Bleakley Financial Group. Stas Melnikov, Head of Quant Research Risk Data Solutions at Stas, which is a software firm. Jason Draho, Head of Asset Allocation America, UBS. And Seema Chetal, Managing Director at JP Morgan, and she does mostly private markets. The current economic situation presents a mix of conflicting signals, to say the least. I'll highlight some of the most noticeable one. Number one, equities are rising like the bull market just started. The S&P 500 is up 22% year to date, having the best performance in 27 years and hitting 47 all-time highs this year. We're currently back to extreme grade on fear and credit index. Number two, global central banks are cutting rates as if global recession is already here. Number three, bonds are falling like the Fed is raising rates again. 10-year US Treasury went from 365 just a few weeks ago to 420, 425. Number four, gold is rising like the Fed is aggressively cutting rates. Gold is up 27% and is on track for the best year in 45 years. Silver has rallied 35% to its high level in 12 years. Number five, oil has collapsed like global recession is coming. 6, home prices are rising like inflation is rebounding. Mortgage rates are rising like the economy is strong. 7, US public debt is skyrocketing and as if there is a financial crisis or a war. US debt interest payments now total nearly 1.2 trillion annually, consuming around 23% of total tax revenue. And lastly, VIX and MOVE index, volatility of stocks and bonds, are trading like something bad is cooking in the markets. On that note, I would like to get some feedback on all these 8 points, not all of 8 points, but few points that you would like to add, and that's how we would like to start this conversation. So, Peter, I'm so pleasure to have you here again. Love hearing you live and also on CNBC. So if you don't mind starting telling us your points.
Is there any particular one of the 8 that you want me to focus on?
Well, you know, you're a little bearish in the market, so.
No, the markets are, I think you highlighted, there's a lot of conflicting things. I've never, in all the years I've been doing this, seen a more sort of mixed and uneven global economy, and I emphasize global. Whether you have India growing at 7%, but you have China decelerating, Germany at best is flatlining, but maybe in a modest recession, while Spain's economy is doing well. Even within the US, you have the upper income consumer that's doing just fine. The lower income consumer is very stressed and value conscious and seeking out deals whenever they can get it. You look at the housing market, the existing home sale market is at 30-year lows, but the new build market's doing better. You have manufacturing that's in a recession, but if you're building a manufacturing facility that's related to the CHIPS Act or the IRA, you know, you have a job right now. So I think all these things together makes it, you know, highly confusing. And I think it's even sort of confusing the Fed. If you read the Fed's beige book, you read the first sentence of the beige book, of the 12 districts, I think 10 are flatlining and 2 are seeing mild growth. That does not equate to a 3% GDP figure. So the Fed, of course, is looking at the beige book and using that as an input to how they decide on monetary policy. But even within, you know, the equity market, up until July, it was all dominated by all the names we know. Then luckily, the market started to broaden out, but those big cap tech stocks sort of topped out. You have bonds, the Fed's cutting short rates, but long rates are going straight up, as you mentioned. So I listen to a lot of conference calls, and a lot of CEOs and are putting their chips on, the Fed's cutting interest rates, but long rates are going higher. So that's even sort of clouding the situation here. So it's a different, I think my bottom line is, and I'll pass it on, is this is not the markets that we were so used to for many decades, where the Fed would cut rates and everything would be fine, and the rates across the curve would fall. And I think we're just in a very different sort of environment, that we need a sort of different playbook than many of us are used to over the previous few decades, particularly the 15 years leading into 2022 when rates were at zero. Those days are over.
Yeah, I'd like to add here, credit card interest rates has hit an all-time high of 23.4%. That's pretty much all-time high. The number of zombie companies in the US is surging. Companies that are not making any money, 70%. And also S&P 500 valuations are at levels reminiscent of the 2000 dot-com bubble, with the price-to-book ratio now at 5.2x, the highest on record. Any comments on that for you, before we pass the torch?
Well, interestingly, in Q3 on the earnings side, the top seven, the loved seven, are supposed to generate all the earnings growth. The 493 earnings growth expectations are zero. Yeah, the market's expensive, but it's been that way for a while. So it's always hard to know when valuations matter, and they don't. I always like to say they don't matter until they do. So we'll have to see on that. I think as we head into tech earnings this week for Q3, the most distinctive thing for me was when we looked at big cap tech earnings for Q2, is the market started to differentiate between those spenders on AI and those receivers of that spend. So the $15 to $17 billion per quarter that Microsoft and Meta and Google and Amazon were all announcing, the markets finally said, okay, we need to call a timeout on this. This is going to be an earnings drag for a period of time, and we don't know when the revenue growth from this is going to be. So outside of Meta, the other stocks have sort of languished. While NVIDIA, the receiver of that spend, we can easily explain why it's back to the highs again. So I think that differentiation, I think, is important, and I think we'll carry through with that this week, and sort of it'll be very company specific as opposed to let's just buy the top 7 stocks. Now it's very fragmented, I think.
Thanks a lot for slicing and dicing the economy. So Stas, could you comment from the fixed income point of view? What do you think about this, I would say, conundrum?
Well, perhaps I can add a couple more statistics to that as well. If you look at the U.S. investment grade option adjusted spread, it was in the low 80s last week. I think last time that happened was 2005. If you look at the volume of debt being traded, probably third to a quarter of that is BBB rated, somehow all in one rating. If you look at the amount of corporate debt outstanding in the United States during global financial crisis, we were at about 5 trillion. We are at over 10 trillion now. And yes, there was inflation in between, but inflation explains only half of that. So if we look at the debt in general, if we look at the sovereign debt, personal debt, corporate debt, we are more indebted as a modern civilization as we have ever been, which may be a byproduct of growth, and if we borrow and invest, and it helps economy grow, but it also introduces a system fragility. And I do worry that the current level of credit spreads is not pricing the risk. So at SAS Institute, we have credit risk models for corporate issuers, and we cover 42,000 companies globally. And if I look at just the US market, within the investment grade space, we are probably about 50th percentile in terms of the outlook for corporate credit risk, the likelihood of default. If you go out to 2 to 3 years, we are in like 60th and 70th percentile, meaning 100th percentile would be the worst outcome. So based on what we're seeing from our internal models, we are not in a no landing, optimistic market. And in general, what we see is those statistics, they're attention grabbing in the headlines, but there's also detail behind those statistics that often gets lost, is that what we call a great bifurcation. We've seen a lot of divergence between winners and losers following the COVID crisis. And that starts with macro outlook. I mean, if you look at United States versus G7, and in fact, the latest IMF forecast upped the GDP outlook for US, and there were some negative revisions on the European side. If we look at the industries, if we look at what's happening for example, in the US with Magnificent Seven, with NVIDIA, versus the rest of the companies, and even within the industries, if you dig down to something like consumer staples. So within consumer staples, you have a whole slew of companies that are getting decimated. We look at the EV, we look at the educational technology, we look at weight loss, which has been hit really hard by the GLP-1 revolution. So you really now have to dig further down into the industry to see what's going on, because these headline numbers are not necessarily reflective of the full story. And there's not really a signs of this bifurcation mean reverting anytime soon, which is troubling. I think it further adds to the system fragility. And just one point to note, Vidak, you mentioned the credit card interest. Credit card interest is not included in CPI calculations either. So
you would agree that the Fed didn't get it right with 50 basis points?
Opinions of my own and don't represent the view of the company, but yes, I think the 50 basis points was a mistake, absolutely.
So where are we going now? I mean, 10-year went from 365 to 425. We're back to at the beginning.
Yeah, I wouldn't be long duration at this point. I think there are a lot of structural issues that have not been present before. So we have the reversal of globalization, which is inflationary. You have climate and green energy transition, which is also inherently inflationary. You have consumers struggling on the working class side of the spectrum, and we see that with the wealth creation numbers too. Again, once you start diving deeper in those numbers, there's some troubling signs.
The consumer is clearly stretched. Jason, in recent weeks, there has been renewed talk about the economy re-accelerating, not decelerating, re-accelerating, and the no landing scenario. Not just soft landing, because economic data has been generally good and above expectations. We've seen this last week. What do you make of this no landing scenario and possible re-acceleration?
You know, a year ago, a little more, there was a debate in the markets of like a hard landing, soft landing. These are somewhat nebulous terms, and they're not necessarily well defined, but I think everyone knew that hard landing means recession, soft landing basically means no recession. I think that's a pretty straightforward thing. Now that the expectations are for like a recession is very low, it's this soft landing, no landing. It's even sort of more undefined what that means. And I think if we surveyed people in the room and said like, how do you define a soft landing? How do you define a no landing? We'd probably get about 50 different responses. So I like to actually try and quantify, like in some sense, like what it means. And a week ago, I wrote a note and I titled it the 5% landing. And by 5%, this is, if you look at the nominal growth in the economy this year, the first half, it's about 5% nominal GDP. In the first half is about 2.5 real GDP growth and about 2.5% inflation. On Wednesday, we'll get the first estimate for third quarter GDP. Tracking estimates are like 3 to 3.3% in that range. The inflation data we have for Q3 would put inflation around 2.5% annualized over the quarter. So rough approximation is that third quarter GDP nominally grew 5.5%. For perspective, the last 3 years, it was over 10%, 9%, and 6% last year. So when I think of a landing, I'm thinking, well, the economy is kind of landing to this level. I think the soft landing perspective is what we were pre-pandemic, where it was basically 4%. You know, you had 2% growth, you had 2% inflation, you had very low rates. I think historically that's the anomaly. I think we'll have something that's higher, if just because of inflation. So that I just try to kind of quantify what we mean. So I think we've kind of landed in this range, give or take, for the time being. Mm-hmm. On the acceleration, I think that's a little bit of taking 2 data points and extrapolating all trend line as opposed to where is the overall trend. My sense so far on the panels, I'm the bull on the market list, the relative optimist. I would pick up a point that Peter made in terms of like there's a lot of differentiation. It's important to acknowledge that. In simple terms, like on a global scale, there's the U.S. and there's everyone else, and the U.S. is doing well. The rest of the world is not doing as well. A week ago, The Economist had on a whole section, talking about, the envy of the world is the U.S. economy. Even within the U.S. economy, there's clearly kind of like a K-shaped kind of bifurcation. There's people who've done very well the last 4 years and other people who've clearly struggled. When you look at the overall aggregate statistics, at least for the consumer, and this is critical when you think about the economy because it's 70%, households in aggregate are in really good shape in the U.S. You'll get a lot of statistics like credit card default rates picking up, but the majority of debt that households has is mortgages. Most people locked in at sub 4% back in 2020, 21, so mortgage rates going higher has not impacted them. In fact, it's not a joke, but like this is reality. There are a lot of people who borrowed 30 years at 3.5%, and for the past year or so, been able to put money in money market funds at 5.5%. That's a pretty good trade for average households. So when I look at households, whether it's total wealth, debt servicing costs as a percentage of income, it's the lowest it's been roughly in 40 years. Real incomes are now rising. I've seen charts where people look at the price index, the CPI index up 23, 24% in the past 4 years. Median household income is up 24%, and it's actually now rising faster than inflation. So all this to me suggests that in aggregate, the US consumer is in good shape. If they're in good shape, it's really hard to have much of a slowdown.
You've been actually writing about the possibility of roaring 20s, which you kind of touched upon. What do you mean by roaring 20s, and why do you think it's possible, if you can just kind of summarize it quickly?
So it's a macroeconomic story, but if you think about equity markets, the S&P 500 total return over the past 5 years, we're 2 months away from the halfway point of this decade, it's kind of hard to believe, it's 94%. That is roaring by any kind of definition in terms of just the performance. By the economy, I mean an economy that's going to grow 2.5 to 3-ish% in real terms, inflation somewhere between 2.5, 3%, so nominal GDP of 5, a Fed funds rate that ultimately probably goes to 3.5%, and the 10-year, say 4 to 4.25% is some sort of range like that. So to me, by that criteria, it is already meeting my definition. It's more a question of will this continue or not. And ultimately it comes down to the supply side. If we think of the 2010s, to me it was a demand side story. There just wasn't a lot of demand after the financial crisis. This decade has been defined by the supply side. First, the pandemic dislocations, and now the question is, and I know we'll be talking about later on, like on the supply side improvements, whether unexpected surge in immigration and labor supply, AI is a supply side story. Ultimately, it's a productivity enhancing tool that shifts the supply curve about how much. So I'm not saying this will continue, but the conditions are in place for this. I kind of thought like the 1990 second half of that decade, that is at least on table right now. That's what I mean by kind of a roaring 20s.
Thanks so much. Let's move from public markets to private markets. Tell us about so-called democratization.
I will talk about that also, but it's a very interesting panel. Thank you for having me here. First of all, I think we did not resolve the question that we started with, that there are different signals. Half the panel here is talking about things are not as rosy, the other half is talking about things are quite rosy. So we didn't quite resolve it. But I think private equity is one way of playing it because you're not playing with a large number of stocks. You're playing in each fund, there are maybe 20, 25 positions. So you can be selective, right? So that's kind of been the story of private equity, that the signals are very mixed. So if you do it stock by stock and you have a portfolio of 25, maybe that's likely to outperform in the public markets, but in the private markets, it's always a case that you're taking a few bets, you have a position as to how things are going to play out, and we can take into account, at least this is my good position to be coming last after this very good discussion. It was amazing discussion. And Stas and I were talking about it earlier, because he's been in the business of predicting what the default rates are going to be, what the credit is going to be. And right now there is none of that, right? There's not distress in any of the markets, whether it's real estate or it's corporate. You don't see that. But if you try to see what is going to be 3 years down the road, because people would have run out of the money, what they have stored away in their balance sheets because they borrowed, everybody borrowed at a very low rate, what it's going to be 3 years out. And his picture is not looking that rosy. So honestly, private equity or private credit actually allows you to say, okay, I'm going to predict what the future is going to be 5 different ways, and then I'm going to invest in something that's actually going to work out. And I'm only going to invest in 3 sectors, not everything in S&P 500 or the ag. So having said this, so that's one thing, it's actually not a bad time. So this half is, the two of us are actually more optimistic. For private equity, it's not a bad time. Usually when things are uncertain, when you're coming off a market high, which, or at least the sentiment high, that tends to be a good time to buy private equity because you're telling the sellers, hey, listen, I'm not going to pay what I paid for my house last time or my company last time. I'm going to pay less because I'm not so sure what the future is going to be like. So it tends to be a good time. That's just historically 30 years back. You can just track that. So it's a good time. On the credit front, the picture is very unclear. The bankruptcies are still low, relatively speaking. The default rates are still low, relatively speaking. And if you're trading in your hedge fund world based on that, you'd say market's fine. And when you're listening to what Jason had to say, again, things kind of seem rosy. And the Fed will come in anyways. The government will come bail us out, and if everything is falling. So that's where the trading is like nobody's trading as if it's any distress in the market, anything that's going to change in the markets. But when we are on the private credit side, or we are taking the position, and these are my views, not JP Morgan's views by any means. We're taking the view that, hey, listen, we are only going to be investing in 3 sectors that are more resilient. And I'm going to have a lot of bells and whistles in my covenant. So if you don't pay me, I'm going to charge you a lot. So that's how I'm going to make money. So I think it's a good way. To your question about democratization, I think that...
Yeah, just briefly, yeah, thanks.
Yeah. The world is colliding in terms of private equity and hedge fund, and has been doing that for a while. Because private equity, me personally, I want more liquidity out of private equity than I have. I want to be able to sell certain shares when I want them. And that is evolving, that there are many structures that are coming up which pay you a little bit less. Instead of making 15%, maybe you'll make 10 or 12% on your equity positions in private equity, but it's behaving more and more like hedge funds, that you can take money out periodically and you can be blocked from taking money out in certain markets. So that's kind of, to me, it's a very interesting development. We can do a whole panel on that, but not today.
Sure, it's a secondaries as well. Yeah. So let's talk about AI adoption. Maybe we can start with you, Stas. You're a software provider, and then get some feedback also from Peter and Jason. What's AI adoption? How is this affecting the market?
Well, of course, we can't have a panel without AI, and AI is real from what we're seeing from a software side. Virtually every customer we have, because Stas is a provider of advanced analytics, we've been around for 48 years, and we've been seeing this big shift in AI. Now, how to make AI useful and actually generate ROI, that's a bit more challenging. And so right now, from a hype side, we're kind of going towards the disillusionment part of that. That does not mean that it's not going to drive positive outcomes going forward. For example, it's really good at segmentation and detection, and we see a number of banks and insurance companies utilizing it to do hyper-personalization, which is really changing the nature of customer experience and ultimately better tailoring the products and the outcomes, which is a win-win on both sides. I mean, we see it as a huge boost in productivity, especially on the research side. I mean, it's like a research assistant on steroids. It's really useful. I mean, you still have to have a human in the loop, and so then it also creates a stronger demand for subject matter experts, the ones who can tell whether it's a hallucination or whether something is real, and that that changes kind of the nature of the employment landscape as well. And so that goes back to the whole great bifurcation theme again, is that they are going to be winners. They're going to be winners among the corporates who will adopt AI and who will see those productivity gains. And there will also be companies who will fall behind, or whose business models are going to be disrupted. So I think the implication of the AI is really that active management now is more important than ever, and I think there will be a lot more opportunities for active managers going forward because of the disruption.
Do you slice and dice public data, or you also slice and dice alternative data?
So for our data offering, it's primarily based on public data, and we are using traditional regression methodologies because explainability in prediction is of paramount importance. Again, as I mentioned before, AI is great at detection and great at segmentation and great at dimensionality reduction. But without knowing exactly why you have a forecast, you can't really act on that. And so that.
So Peter, AI adoption, how does it affect stock market, bond yields? in your opinion?
Well, the first AI papers were written in 1950. So AI is not new. We're really talking about like the new iteration of it. And one of the interesting comments from the CEO of Microsoft, Satya Nadella, in their second quarter earnings, said at the end of the day, generative AI is just software, which it is. But software, every new iteration of software, every new iPhone, every new Microsoft product, every piece of software constantly gets better. Now, maybe this is a further leap in terms of improving the software and our ability to be more efficient and more productive in utilizing it. So from our perspective and how we use it, it's just another enhancement to the software that we use. Again, hopefully this is like a further leap. Now, from the stock market side and how do you make money, that's still the debate. Because when you're spending the many billions of dollars to build this out, it will take time for those developers to reap that benefit. So I think it's technology is an incredible thing, and this is just another form of it that this year it's better than last year, and last year was more improved from the year before. So I think just to have some of that perspective with this.
Thanks, Peter. Jason, what?
So AI is kind of all-encompassing in many ways, and I like to try and think about it in terms of like the known unknowns and the unknowns that unknowns to some extent. What we know right now is, and Stas alluded to, like there's a hype cycle that's probably, there's a little bit of cynicism, like where's the return on investment thus far? But it also seems like, and you hear this from the CEOs, and we'll know in the next 3 days as 5 of the Mag 7 report, that the CapEx spending just keep getting ramped up. Like, so you're still building the infrastructure. Jensen Huang recently kind of, at another conference kind of said like the demand essentially is insane. I'm not sure how to quantify it, but it's like, obviously just keeps going higher. There doesn't seem like in the near term, meaning the next 6, 12 months, that's going to abate. So that aspect seems real and legitimate. When you look at the stock market performance, though, there's clearly differentiation between NVIDIA, a few other clear beneficiaries. I think people think Microsoft will be a clear beneficiary. But stocks that are sort of at the second order that are AI related have done next to nothing this year. Like they've definitely kind of differentiation on that. So I think that's sort of what we know with some confidence. 3 years down the line, how are companies going to monetize it? That still remains to be seen. Then I think about a little more of the macro perspective. What are the implications? One is just the amount of investment. Like we're talking about 4 companies that combined could spend $150 billion this year on investment. Like that is big enough to have a macroeconomic impact. You're seeing stories like this morning of like, nuclear, small scale kind of nuclear factories to try and power this generation investment that has to take place there. So the spin-off effects for the economy overall are not trivial at this point in time. Mm-hmm. The biggest unknown is ultimately like, how does this improve worker productivity? It's a software tool. We know from the 80s and 90s it's had real implications, positive implications. It's still very early in terms of assessing those implications. The adoption rate, if you look at things like people using ChatGPT versus internet or iPhone, like it's a faster adoption rate. There's a thought that because it's already integrated or can be integrated into software tools, your phone, that people will use these tools more quickly. I'll have a better answer in 2 weeks because I know internally in our systems, like in HR, there's supposed to be AI tools that'll help you write performance reviews. So we'll see if it actually saves me time or not. So I'll have a bit of more clarity in the next 2 weeks on that. Is it enough to ultimately kind of be kind of a game changer, really lift productivity in a positive way? Probably the question is really the time and the magnitude, and that might be 2-3 years down the line, at least.
Thanks, Jason. So political, from AI game changer to political configurations. We all know what's happening next week. So if each of you can provide some color, what political configuration in DC mean for your portfolio?
So we're not changing one thing regardless of who wins. I think the market does a very good job of trying to suss out the politics versus what policies will directly affect economic activity and earnings. And when you break it down, just by the math, it's obviously taxes, because that flows through to what we keep and what we spend and what flows through an income statement. And then, of course, the regulatory side. Now, on the tax side, Trump in 2016 had the benefit of taxes to cut. There was low-hanging fruit on the corporate side, and obviously he did what he did on the personal income side with other things. So the corporate income tax rate is unlikely to change. So at best, it stays the same. On the income tax side, we know his tax cuts expire at the end of 2025, and obviously depending on the makeup of Congress and wherever, to what extent will they get extended? But even if Kamala wins, the state of the economy could determine whether she wants to extend them or not. Because we have to remember that Obama in 2009 extended almost all of the Bush tax cuts because we were coming out of a recession. On the regulatory side, I am just sort of debating in my head that when the Supreme Court overturned that Chevron case, did that mean that the executive branch was going to be less influential in terms of running the regulatory state? And is it going to be more in the hands of Congress to write detailed laws that's not up for agency interpretation, and will be up to the judges to decide the legacy regulatory structure that many businesses are going to sue over, of course, and that maybe we're going to have new heads of the different agencies if Trump wins. Maybe they'll be, again, more or less influential because of that case. We'll have to see. I guess my bottom line is we are not changing one thing. We're long energy stocks, so people ask, well, are you going to change if Trump wins and drill? But we're not, because everyone's drilling what they want on private lands. This is just opening up some public lands. I don't think that's really going to be a needle mover anyway. So we're not changing a thing now. We have to be cognizant of what's going to happen and who's going to take control of Congress and what comes our way. But at least initially, I don't find the need to really make any changes.
Thanks, Peter. Thanks a lot. Stas, from 10-year Treasury bond perspective, Republicans, Democrats?
Well, I think it comes down to the policies that they're able to enact following the election and the implication on the inflation, because really it's more than a 10-year, it's about the bond stock correlation and really what's driving the movements in those markets, whether it's the worry about inflation, which means that they're positive and you don't have the diversification from treasuries, or it's negative where you have worry about the economy and you actually have the flight to safety, and to what extent that safety is defined. And I think we've seen some pretty big swings in that regard, where post-COVID pandemic, the correlation was positive, and we only had few of those moments before, like during the taper tantrum and a few others, but most of this century, we actually enjoyed the negative correlation, the hedging effect of the treasuries. And I think depending on what happens with inflation, it may or may not continue. So I think, to me, that's the key point to watch here and how it impacts the multi-asset portfolios.
Thanks, Stas. And in terms of asset allocation, Jason, please go ahead.
So I'd pick up on Stas's comment about the relationship between stocks and bonds. For 20 years, it was kind of a perfect, like bonds, treasury bonds were sort of a perfect asset class from about 2002 up until essentially January 3rd of 2022, if you had a bond portfolio at that time, because they had a negative correlation with stocks. So if stocks sold off, bonds rallied, so that diversified your portfolio. They had a good return because starting yields back in 2000 were around 6%, and they had relatively low volatility. So today, starting yields a little bit lower, but still not bad, all things considered, compared to where we were. Volatility still and should be relatively contained, but this correlation, I think that's probably not going to go back to what it was before. And in simple terms, I think in an environment where the markets are more worried about growth, and for the 2010s at least, you were more worried about slipping into recession, the correlation tends to be negative. When you're more worried about inflation, and I think that's going to be the risk going forward, that inflation can be contained, but the risks are always skewed to a little inflation shocks, that correlation is not going to be as negative, it may be positive. So from portfolio construction and asset allocation, then you have to think about, well, if bonds aren't going to diversify my portfolio, I have to think about other asset classes. And so privates are, I think, kind of front and center, whether it's hedge fund strategies, private equity, private credit, infrastructure, real assets that could again provide some return there. So that's definitely one thing that we think about, how do you add and diversify. The second thing, and this actually kind of picks up on a point that you mentioned early on, the number of zombie companies. I think of particularly small caps. You hear these statistics out of the Russell 2000 index. Is it 30 or 40% don't make any money? Now, the small cap sector overall, I think, has changed a lot in 25, 30 years. The number of public companies in the US was over 8,000 back in 1995, 96. Now it's less than 4,000. And a big part of that is private equity has kind of taken up a lot. Companies that might have gone public, they're going through the private route. It does kind of raise the question to me, if private equities looked at the Russell 2000 and bought all the good stuff, and if I want to buy it as a public investor, like, am I getting kind of an adverse, like the Lemons problem? Which does mean that, and we look at like, well, now you almost have no choice but as an asset allocator to look to private markets because there are opportunities there that weren't there 10 years ago, certainly 20 or 30 years ago. So thinking about portfolio diversification and thinking about your opportunity set, that is, I think, sort of fundamentally changed versus, even just 5 years ago.
Great, thank you, Jason. And Mina, from private markets, private equity point of view, what does it represent for you in terms of DC configuration?
Right. So I think, hearing what we just heard, everybody was focused on growth. Everybody wanted growth, the growth, and we know in the S&P right now is 5 growth companies which are doing well. So now I am beginning to look more at, not necessarily growth. The companies, you don't think about industrial services, you don't think about transportation. They're all benefiting from the trends that we're talking about. A lot of capital spending in energy space, a lot of capital spending everywhere. The different acts that are supporting it, infrastructure bill that's supporting it. So maybe one should look into industrial services, and it doesn't have to be very large companies. It could be small companies. For instance, I'm looking at maybe 5 or 10 different opportunities where the funds are giving 20, 30% returns, but they're not necessarily very large funds. They're small funds focused on Main Street America, which are benefiting from a lot of CapEx spending that is happening. So I'm looking at that. On the real estate side, I know that construction lending has been, banks are not lending because everybody has been risk averse because of all that's going on. And nobody's sure about what's going to happen in the rates market. The data is not equating with what you're seeing in the real economy. So construction lending, which is considered to be more opportunistic, more risky, nobody's lending, very little lending and very little new construction. But we know that people need housing, people need, e-commerce is growing, so you need industrial space, and there are certain demographics or certain regions that are doing very well. So I'm looking into exploring where construction lending could be made. And they could give you uncorrelated return, nothing to do with which direction the rates move, but because they're high enough that they could give good interest. Thank you.
Okay. On that note, thank you all for your remarkable insights. We appreciate it, and thank you for joining us. And now we're going to have a lunch.